Unless you want to pay 10 goats, do not break these mortgage commandments.
What does 100% financing mean? It
Free
means
houses.
free houses.
For everybody. You get a house. You get a house. You get a house. I'm going to try to sit normally this time too. Here we go.
I didn't think we were sitting.
I wouldn't read too much into it. I can't believe they man-spread it at me the entire time.
Scared of the blooper reel. Finance Fridays! Yeah. We're getting better at this.
Yeah.
What is up, YouTube? Matt McKeever here, and I mean, it's kind of crazy to think that the crazy year that was 2020 is coming to an end. And there's a lot of different things that we could look back on in regards to 2020, but in today's video, we really want to look back upon the special team up or partnership that occurred between my YouTube channel and Josh and Ehren from the Findlay Mortgage Team. So if you guys don't remember how it all got started, way back in April of 2020, we decided to start cranking out content for you guys every Friday on the YouTube channel around mortgages. And during that time, we've shot like over 28 videos. You know, we've got over 5,000 hours of watch time, over 42,000 views. The like button's been smashed over 2,000 times, which is amazing. And by the way, I'd love it if you smashed the like button on this video. But today we thought, well, seeing how we've got almost 30 amazing videos with these guys, what if we just created a highlight reel of all the best tips, tricks, and mortgage advice they gave to us over the course of 2020? Because, I mean, 2020 was definitely a choose your own adventure when it came to life. Like, a lot of people accomplished a lot of shit in 2020, and there's a lot of people that didn't even get out of the starting point, right? They didn't even leave the starting blocks. And so when it comes to that, I thought, let's look back at the starting blocks for Josh and Ehren on my YouTube channel, because I think they've changed a lot over this course of this year. So before we jump into the great mortgage tips, let's jump into the very first video that Josh and Ehren shot on my YouTube channel. What is up, YouTube? Matt McKeever here, and in today's video, we got really, I mean, this is a one-of-a-kind video. I don't think that the majority of people are going to watch this video. I think the majority of people are going to skip over it. They're going to complain about the audio or lighting not being on point, while the information is absolute fire. I'm not positive, but I might have killed for this information back in 2010, because had I had people like Josh and Ehren in my life helping advise me in regards to mortgages back then, I think I'd have a much bigger real estate empire than I currently do today. This is 30 minutes of pure fire information. It was originally a 3-part series that we decided to put together into this one-stop shop when it comes to financing real estate here in Canada. My biggest struggles as a real estate investor was finding a mortgage agent or broker that was truly investor oriented. And these guys are. When we've got a difficult or strange or unusual deal, we bring it to them, and they magically find us money for our deals. It's a great relationship. I encourage you to reach out to them if you're interested in hitting them up, but let's dive into today's fire video.
Hey guys, I'm Josh Findlay.
I'm Aaron Laycock.
And we're with the Findlay Mortgage Team.
Matt had wanted us to run through a few different scenarios for you guys for some refinance cases. So we're going to do a 3-part series. The first part that we're going to have here is a AAA client. So good credit, good income, good debt servicing ratios on the rental property.
My clients own a primary residence in which they use as their personal residence, and they also own a rental property. Clients use this as a tool for investment, and currently they're looking to pull some equity out for cash flow purposes.
I always love watching people's first time on my YouTube channel. It's usually just, it's so refreshing to see kind of the bushy-tailed, you know, wet behind the ears approach that they often take versus who they become after they've been on my channel a few dozen times like the guys have been at this point in time. But if you didn't realize that that first video now has over 7,800 views, I think the like button's been smashed over 200 times, so absolutely amazing, and really glad that you guys have enjoyed and been sharing that video. But really, that video is just the tip of the iceberg when we're talking about all the content that we shot with Josh and Ehren. Mortgage approval, mortgage.
The mortgage with your mortgage application process.
Mortgage hacks, finance.
Insured mortgage. So that insured mortgage down payment is
That down payment.
mortgage. So our down payment, mortgage, and
Down payment.
what your new mortgage is, a refinance. Our AAA mortgage.
The perfect mortgage package, mortgage broker, or private finance.
Mortgage, private financing.
Finances, a financing request.
A perfect mortgage package.
Down payment, mortgage,
Down payment.
Financing.
Construction financing. Creative financing.
Piece of raw land.
raw land.
Raw land financing. In today's video, the guys are really going to break down for us, just kind of piece by piece, what's going on when it comes to down payments here in Canada.
Your down payment.
Traditional down payment methods and non-traditional down payment methods.
Down payment is
That down payment.
your down payment.
Down payment.
Down payment.
Down payment.
We've got the Findlay team back. Hey, Josh and Ehren. And so they're going to be breaking down for us exactly a 7-step process to getting that mortgage approval.
The mortgage.
With your mortgage application process. Pre-approval process.
The pre-approval process.
Pre-approval and
The full approvals.
income, your credit, your down payment, and the property itself. So
what are the tips? Like I said, we've shot a lot of videos with Josh and Ehren at this point in time, and it's pretty much impossible for me to pick a favorite tip or a favorite video, so I had the team put together this giant compilation of all the amazing tips that they've shared, all the amazing mortgage hacks, all the insights that they've provided on my YouTube channel, completely free this entire year. So that's what you guys are about to watch. But what I need from you guys is a timestamp of your favorite clip during this episode. So let us know, what's your absolute favorite tip that's about to come up. And I haven't discussed it with Josh and Ehren, but they're pretty cool guys, so I assume I'm going to get away with this. And we're going to pick one lucky winner to just jump on like a 1-hour coaching call with Josh and Ehren to discuss mortgages and personal finances and all that great stuff. If you've got some questions for a mortgage agent that maybe you've been scared to ask, this is your opportunity. So all you need to do is timestamp your favorite tip coming up in the next compilation, and we'll pick one lucky winner. But I mean, if you get all these tips, you're already a winner. A 7-step process to getting that mortgage approval.
There are a handful of steps that we take into account when trying to get you an approval.
the first step in the mortgage process is going to be the initial consultation with your mortgage agent or broker.
Second step is the approval request. This specific step is going to allow us to take a full assessment of your personal credentials.
Step number 3 is the pre-approval process.
Step number 4 is the full approval. So this is the real deal. This is when we kind of put the actual real deal information into our underwriting system and cross-reference it with the information that we already have on file. And this is where we will start to decide what lender we're going to go to, what product is right for you, and we start really figuring out the rate and the product, and this is where everything kind of comes together.
So step number 5 is the conditional commitment process. After we've received the full approval from the lender, they're going to issue a conditional commitment. This commitment is going to have 2 sets of conditions that's going to need to be met.
Pre-closing, this is about 7 to 10 days before your closing date. Your lawyer is going to get in touch with you. You're going to go sign the actual documents. And so a lot of people don't know this, but the documents you sign with your mortgage broker are tertiary documents. They can be changed. They're kind of moldable in case something is to change or something happens.
The closing is exactly that. You're closing on the mortgage and on the financing. Congratulations on your purchase. And today we're going to be talking to you about residential commercial bridge loans.
The bridge loan, bridge financing.
Bridge loans, it's a short-term loan, usually offered by the big six banks. And the maximum amount of loan that you're going to be able to take out is usually around $200,000 for a majority of 120 days. Now, why would you need one of these bridge loans on the residential side? You're selling your home outside of your purchase date. You're going to get that loan from the bank, and they're going to give you that to help extend the time from your purchase to the sale of your property, which then you can use the equity to pay out that loan.
Hey, how do I qualify for this loan? That's a great question. So you don't specifically qualify for the bridge loan, you qualify for the purchase of your home. The bank is basically lending or giving you this opportunity as a service for a little bit of a fee to be able to move forward with your purchase. This isn't a long-term solution. This is a very short-term, just to bridge a gap between a sale and a purchase. Today we wanted to talk to you guys about some of the top mortgage questions that we get on a daily basis. How do you qualify for a loan? Qualifying for a loan has a handful of different variables involved. The first being a consultation. Your goals, your debt servicing, your credit. We take all these factors into consideration when trying to qualify you for a loan. It's really going to depend on a handful of different factors. A lot of it has to do with your total income and your total debt load. From there, we can kind of figure out exactly how much you can refinance or how much you can purchase.
How much did you save for a down payment? So there's a couple different things that are important to consider when asking this question. For the first part, is it going to be an insured mortgage? If the property is going to be purchased with mortgage insurance, there's two different down payment rules that you have to follow. A 1 to 2 unit property can be purchased with a 5% down payment, and then a 3 to 4 unit can be purchased with as little as 10% down. There are 3 different insurance companies in Canada. The first one is CMHC, the second one is Genworth, and then the third one is the Canada Guarantee Company. Now, the rule of thumb is typically any down payment under 20% is an insured mortgage. And then once you get into that 20% and above range, you're no longer in an insured product and it becomes an uninsured mortgage. Now, once we go past this 20% mark, we are able to get a little more creative. So for example, we can extend the amortization out from 25 to 30 and sometimes even 35 years, depending if it's a B lender. And this extension of the amortization can actually help to minimize your monthly payments and help to qualify with your debt servicing ratios. In terms of the down payments, the most important questions to ask is where are these funds coming from? Depending on what type of purchase you're looking to do, you are restricted as to where those funds can come from for your down payment.
How do you know what mortgage option is right for you? There's 2 types of options we're going to talk about today. The first is a fixed rate mortgage. The second is a variable rate mortgage. Fixed rate mortgages are based off of the bond yields, so the banks lend money based off of that specific metric. In regards to a variable rate interest, it's exactly as it sounds. So your mortgage payment is actually going to change depending on what prime rate is. So if prime rate goes up, then your mortgage payment goes up and it goes down. So as you know, markets ebb and flow depending on how the market is doing or economic factors are doing. Usually a variable rate mortgage is cheaper than a fixed rate mortgage and more enticing for most borrowers. It does cause a little bit of uncertainty in regards to your mortgage payment and could change depending on economic factors.
How do interest rates affect your mortgage? Now it's important to kind of understand that your interest rate will change based off the length of term. So for the banks, the lowest rate that they're going to offer is typically on a 5-year rate on the AAA side, more specifically. So as you start to decrease in your term, the lender is obviously going to be holding on to your mortgage for less amount of time. So the rate does tend to increase just to help offset that length of time. Now on the B side, it does actually change a little bit, where the 5-year rate can actually be one of the more expensive rates that lender can offer, where the 1-year rate typically is one of the lowest rates that the B lenders have to offer. So again, it depends on the length of term that you're looking for as well too. The more important part in terms of interest rate isn't exactly the interest rate itself. It's more about what does that product bring for you. So some important things to consider are, is it a fixed or variable rate, which Josh just talked about? What kind of interest penalties come with those types of terms? So these are some very important things to kind of consider a little bit more opposed to than just what is my interest rate.
11 of the most important mortgage hacks in Canada that you guys need to be aware of. So what are the tips?
Yeah, so I think the first tip we want to talk about is a little bit of a house hacking tip, and I'm sure some of you heard it, but some of you who are a little bit new to the investing, you maybe haven't heard of this yet, but getting into a home, an owner-occupied rental property with an insured mortgage. So that insured mortgage means you get to put a minimum amount of down payment down to get into the property. That's going to save on your capital and a bit of cash flow down the road. So for a 1 to 2 unit owner-occupied purchase, you can get away with 5% down on the property. Very minimal capital down. That's as low as you're going to get on a down payment on the in purchases in general. A 3 to 4 unit owner occupied, you can get away with 10% down. Again, it's an insured purchase, but getting in there with as minimal down payment as you can, open up that cash flow and save some of that capital for either another purchase or some renovations on the property.
Yeah, really powerful, because I know a lot of the audience that haven't bought their first investment property, usually what's holding them back is that down payment, right? So if they can find a way to break into that first deal, with an insured product by maybe house hacking the property, there's a lot of potential there. Because for a lot of investors, what we need is that first case study. Once we've done this once, then we can prove to people we can replicate this process, that we've actually got a system and an entire business model behind it.
So tip number 6, guys, something that's going to be really important for, especially on the BRRRR strategy. You guys want to be able to refinance out, making sure that you have the equity available to, just to be able to refinance, but also hopefully be able to recoup some of the renovation costs that you guys put in there as well too. Something to consider is changing your payment structure a little bit. It might scare you a little bit because your payment's going to be a little bit higher, but if you look at what that enables you to do on an exit strategy, if that means that you're paying more down on your monthly payment to increase the amount of equity in there, that means that you're more likely to be able to be refinanced at the minimum amount of loan to value, but also to be able to maybe recoup some of those costs and pay down either your lines or credits, or pay back some borrowed invested money if that's whatever your case was. So the two options that you can consider are an accelerated biweekly payment or an accelerated monthly payment. And essentially, it adds an extra payment cycle throughout the year. But through that 1 year, that might be the difference of being able to refinance or refinance and recoup some of your initial investment.
Yeah, I know when I was originally investing, before I was really focused on maximizing my exposure to debt and leverage so I could control as much assets as possible. I went with that weekly mortgage payment, and then I would be that annoying guy that every other month I'd call the bank and be like, I'd like to increase my payment by $10. I'd like to increase it by $20, and I would just keep inching it up. But all of a sudden you'd go 20-year amortization to 16, to 15, to 14, and you're like, this is kind of cool, this is fun. And so if you're definitely in that first stage of investing, you may not have fully embraced debt 100% yet, where I know that more sophisticated investors are just like, how can I get 105% debt? But for the newer investors out there, right, yeah, just drown me in debt. Trust me, I'll figure out a way to swim. So we've been talking a lot about Josh and Ehren up until this point, but there is actually another team member on the Findlay Mortgage Team, Scott Findlay. And so he's been on the channel multiple times, really talking about the higher level, bigger projects, development deals, the stuff that you guys always inundate me with questions on, that sometimes you're so far out into the weeds, I don't even know how to answer them. So it's been amazing having Scott on the channel, because he's coming with over 20 years of mortgage experience that he can really just share his breadth and depth of knowledge with the channel. So let's look at some of the highlights from Scott. I've got Scott today, who's an expert from Findlay Mortgages in financing land development.
Land development financing of land financing. To start with raw land. With land financing, raw land.
Raw land financing.
Zoning of the land, 20 acres of land available. How do I pick that up? Mezzanine financing.
Mezzanine financing.
Mezzanine financing, construction financing.
It's the construction process. So how's construction work?
Developer went from $9.9 million to $31.5 million in value just by having a stamp from the city of Kitchener that he was site plan approved for a 550 unit condo. Wow. Now you're talking about big money. Construction money is typically big money. Construction mortgage, construction financing.
The construction process.
Construction financing is incredibly labor intensive for the lender. Construction financing can go anywhere from 4.75 to 11%.
Consumer proposal or bankruptcy in your financing. Scott from the Findlay team, consumer proposal. What a consumer proposal is?
Debt. Two options. Number one option is just wiping the slate clean, and that's called a bankruptcy. Bankruptcy, pay a fee to a bankruptcy trustee. You go into bankruptcy, creditor proposal. Creditor proposal, a bankruptcy trustee will negotiate a discount on that debt, enter you into a proposal, and extrapolate that payment schedule over a 4-year period. A consumer proposal is essentially saying, I want to make good on my debt. I can't afford to, but here's what I can afford to do. They set you a payment schedule, and away you go.
With a consumer proposal, but still owning some real estate, there's still some options available for them?
We have lenders at the Findlay Mortgage Team that will allow you to use the equity in your home to purchase yourself out of consumer proposal. If I want to pay off my proposal and purchase a rental property, I can use the equity in my home that's grown. I can pull that equity out. I can pay myself out of bankruptcy. Once I'm out of bankruptcy, 1 day out of bankruptcy, I'll now qualify for a mortgage again at certain lenders. Huge myth out there that after going to consumer proposal or going to bankruptcy, that your financial life basically is ruined for 7 years, and that's just not the case. What that 7-year myth is that for 7 years it's going to stay on your credit bureau.
All that means is that that's on my record, and maybe it's going to be a little bit harder or more expensive for me to borrow money, but it doesn't mean it's impossible.
100% correct.
We're back with Scott from the Findlay Mortgage Team, conforming and non-conforming properties.
Conforming and non-conforming properties. Is it legal to have a tenant in there? Can I use the income in that unit to qualify for a mortgage? A conforming and non-conforming unit, a legal unit.
Legal unit versus an illegal unit.
A conforming rental unit is a rental unit that fits all of today's building code and zoning. The non-conforming unit, that's still a legal unit, but it may have been grandfathered in. It may have been a unit when we had a previous electrical code, may have been a unit when we had a previous zoning in the area. Typically, when you see non-conforming units, it would be in areas such as like downtown cores where you'd have these large houses and let's say back in the 60s and 70s, they were cutting these houses up into smaller accessory apartments. If you had a home that had those units in there already, those units are legal, but they're non-conforming, so they don't fit to today's building code, they don't fit to the standards. But when you get into non-registered or illegal apartments, this is where things get a bit tricky. You can get yourself into quite hot water going down this road, $50,000 to $75,000 in value bump in a property just by legalizing a basement apartment alone.
All right, reminder, if you made it to this end, I'm going to guess that you had a favorite clip that you just saw. So what we need from you is your timestamp in the comment section down below. We'll reach out to one lucky winner who will get a 1-hour coaching call with Josh and Ehren just to discuss mortgages, finances, building your real estate empire, whatever questions you've got for a mortgage agent. This will be a no-holds-bar consultation. So again, I hope you guys get value from this video. If you did get value, what I need you to do is smash that like button, hit the subscribe button if you're new to my channel, and until next time, remember, this is just the tip of the iceberg of the amazing content we've got on my YouTube channel. We've shot over 800 videos at this point in time, so I mean, just go watch more of it. Dig deep into the archives. There's so much information here, and we're still getting started. We've only been doing this for 4 years.
Scared of the blooper reel. Finance Fridays.
Yeah.
Perfect.
Okay.
You did a good job there, buddy. Good job.
Awesome.
You're just like, oh yeah.
You got it all, man.
Okay.
I'm gonna try to sit normally this time too. Here we go.
I didn't think we were sitting.
I wouldn't read too much into it. I can't believe they man-spreaded at me the entire time.
So, you know, oh man, what just happened there? Just had the biggest brain fart. Yeah. Cut that out. Just trying to get the pounds down. Oh, I messed that up. That's on this. That's on the second. Okay, let me read it again. Oh, stretch the legs. Yeah. Good to go. Yeah. We're talking about a single-family home that maybe has a small.
Yeah, you can keep going.
For that open term to not incur any of the upfront costs or penalties.
Just interesting how doorbell doesn't ring the entire time you're writing out.
I know. I really wrote out for 2 hours nothing. We're 5 minutes in, 3 times.
Never rings.
I know. People normally can't even find it. Yeah.
The first video I put up on our Instagram channel,
Yeah.
the only comment, Aunt Sue, Josh doesn't have his fancy socks on yet.
This morning I woke up, was like, gotta pack it.
Gotta have the sock game on point.
We're getting better at this shit.
Yeah, that was
Oh
good.
yeah.